But we have an interesting situation that the central banks are really bottomless money printers. There doesn't seem to be any limit. And the Federal Reserve owns hundreds and hundreds of securities, and these central banks buy up all these securities, and companies are buying back their own stock. And the cost of doing all this is zero because interest rates are zero. And so I think we have further to go, really. I mean, these central banks can add another 10, 20 trillion dollars of assets to their balance sheets. And so the momentum is certainly there, and we could see this go higher. Obviously, there's a high concentration in just a few names in the US. Those names are well known: Apple, Amazon, to name two. And there's no reason why we're not going to see them continue at the current trend and for the short term. You have two groups. You have the Robinhood traders, which we can talk about in a moment, but you also have Warren Buffett. So what's Warren Buffett doing? Warren Buffett has got a huge cash position. Warren Buffett has recently moved into a gold stock, which is very different kind of investment than he's used to making over the past decades. And as of this week, he's now got a big position in Japanese stocks, Japanese conglomerates. So he's getting out of the dollar. I think that's pretty clear. And that should be a red flag to folks out there that one of the world's most successful investors is getting out of the dollar. As far as the dollar goes, if you look at the best performing markets in the world, they're actually like Zimbabwe, Venezuela, Iran. It's because those currencies are collapsing. So you have to ask yourself, are they reflecting loss of confidence in the dollar? I think the answer is yes, to a large degree. Ray Dalio, big hedge fund guy, one of the biggest in the world, he's got 20% in gold now. That should also be a warning to those who don't think we're going to see inflation. The biggest loser would be in the bond market. So I think you've got to look at the bond market should be the kind of indicator that we're at the end of this cycle, right? Because the bond market is going to have to come to grips with at some point with this collapse of the dollar and this rise of inflation, right? Inflation is the enemy of the bond market. So I don't know how much longer they can keep that bond market going. Once you start seeing the bond market invert and start to slip away, then you got to take a defensive position. And you've already seen the smart money moving into gold and Bitcoin. So then getting back to the Robinhood traders, I don't think they're going to be nimble enough to escape the blade of the guillotine once it falls. And that's typical. Every generation usually gets crushed by at least, by a collapse. I've been through three of them. Wow. The 87 crash, I was working on Wall Street. The dot-com crash, I had a dot-com company. And the 2008 crash, I was mostly just a journalist at that point reporting on it. So this would be my fourth eyewitness to a major crash. Robinhood traders, fascinating thing to me and unusual. I would say in my close to 40 years in the markets, I've never seen a phenomenon like Tesla. Really, it's up again today post-split. It's well over a $400 billion valuation. I think it's getting close to $450 billion valuation. And this is, I think I've never seen anything like that in my 40 years. Well, Barrick Gold is a leveraged play on gold, and it does pay a dividend. And if you like gold, why not get a leveraged position in gold? So I think it would make more sense to him from that point of view. I guess, again, both Ray Dalio and also this Ohio pensions fund that just reported the last week or so, they went from a zero allocation of gold to 5% gold. So now if the institutional money starts getting off zero and moving to 5% position in gold, that's huge demand. That's a $50 trillion market that goes suddenly they want an allocation of 5% gold. Gold's at just under $9 trillion market cap, but if you add up the global money management universe, it's about 100 trillion. And right now, in aggregate, it's less than 1% in gold. So let's say everyone decides, you know what, I'm going to follow Warren Buffett, I'm going to follow Ray Dalio, I'm going to follow this pension account, I'm going to go 5% gold to be prudent because I need an inflation hedge. Okay, so that's now a $5 trillion demand on a $9 trillion market. That's already, the supplies are tight, and the COMEX and the LBMA are already, there's a run on those two institutions where they can't source the gold. So you could see a massive short squeeze, massive demand, all coming together. Gold gapping up to 3, 4, 5,000 over a week. I don't think that would be really shouldn't be a big shock to folks at this point. Well, and you have to keep in mind also that when there's trouble on these exchanges, like for example today, several of the exchanges, including Merrill Lynch, were not operating. They were technically in default. They were not processing trades. And I think so people have to realize that when they start to run for the exits, it may not be easy to get out. When I was working on Wall Street during the 1987 crash, we would put an order in on that Monday, Black Monday, and I didn't get an execution until that Thursday.
Wow.
That's how backed up they were.
Yeah.
And you had no idea what you bought or sold, or in this case, sell. You had no idea what the print was for 4 days.
Wow.
So how do you manage those margin accounts? How do you manage those accounts? How do you know? You're completely blind. So here you have a bunch of traders who they're margined, no doubt, and they're in options market, no doubt. And then suddenly you have no access to these platforms for several days. And that's where the danger is. With gold and silver, you can store it outside of the system, and there is no counterparty risk.
Yeah.
If you have gold and you store it in a vault, and there are several vaulting services that are good, you don't have that issue. And that's going to be a big issue going forward, is just the mechanics of these platforms, because they're very new. I mean, Robinhood goes down every couple of weeks. Imagine if you have a crash like scenario and suddenly I don't know how many millions of users they have, something like 40 million users. I forget the exact number, but they're all going to come in together and try to get out at the same day. Their technology doesn't scale. I mean, not to that extent, not simultaneously. It's going to take them a long time to put in the servers just to handle that traffic, right? So now that's a huge risk. And when you sign up to these services, you sign off, and you are essentially signing away your right to sue them for inaccessibility to your funds in case of force majeure, or, in case of a problem, right? So you have no recourse. And so you're just going to be, it's a big problem. With gold and silver, you have the ability, and Bitcoin, to essentially custodian those assets outside of all these systems. And that's a huge advantage. And I think people need who are stock players who are averse to these as their assets like gold, silver, and Bitcoin. Just think about what I'm saying here for a second in terms of managing your risk. You need to be able to function in case of duress. And if everything is locked down, you're going to have no access to anything for a number of days or longer, and that could be a big problem. Sure. The Bitcoin technology is it's profound, and it's philosophical in some ways, because it's the first asset that we've seen that enjoys absolute scarcity. So in terms of, it's different than gold, because gold is relatively scarce, but we know the supply, the stock to flow ratio, et cetera, the supply is increasing by roughly 2% a year, and people drill for gold, and there might be asteroids with gold, and potentially you can find gold in seawater and stuff like that. But it doesn't have this attribute of being absolutely scarce. So Bitcoin has this attribute. It's very unique in that sense, and that people use it as a gold substitute, and that it's completely outside of the state, and that it issues its monetary policy is to issue new coins every 10 minutes. And as a result, people who start to invest in Bitcoin, or start to put their savings into Bitcoin, it tends to kind of change the way they think. We've seen this already in gold, because people who gold buyers tend to think more in terms of savings than spending, right? I mean, and Keynesian economics is all about spending and going into debt. And in American financial press is always propagandizing savings as being bad